This is Trend Following Radio, where great thinking comes alive. Nobel Prize winners, legendary traders, best-selling authors, and the pros that know what drive us irrational human beings. I am your host, Michael Covel. Not filtered, raw, honest. That's my passion. Back in the late 90s, the early 2000s, an author caught my eye, Michael Mauboussin. He's gone on to write multiple books, great books, and always has this interesting perspective. People say outside the box. Michael goes outside the box all the time. One of his white papers back in January of 2002, I'm looking at it now so I can recall that, caught my eye. It was called the Babe Ruth Effect, Frequency versus Magnitude. And really what it was getting at, from my perspective, now Michael wasn't attempting to connect the dots on trend following, but for me, a guy that was interested in trend following, I was like, wow, this is fabulous. This white paper is outlining so much of what trend following is all about, which is that the big wins, the rare few big wins, the magnitude of those big wins, the size, will pay for all your small losses. And the predicate there is that in any kind of investing endeavor, you don't know what the winners are going to be. So you got to place a lot of bets. You're going to end up with big winners. You're going to end up with small losses. And what you're trying to capture is a positive expected value. The Babe Ruth Effect. Let me quote from the Babe himself. How to hit home runs. I swing as hard as I can and I try to swing right through the ball. The harder you grip the bat, the more you can swing through the ball and the farther the ball will go. I swing big with everything I've got. I hit big or I miss big. Attributable to one famous Babe Ruth. It makes sense in hindsight, or it makes sense once you start to break it down from that perspective. In Michael's paper, he says it quite clearly. The expected value mindset is by no means limited to investing. It's across an assortment of fields. Hint, that's where I'm going to go today. And I'm just picking some highlights from Michael's paper. You can go find this online very easily. But he concludes, constantly thinking in expected value terms requires discipline and is somewhat unnatural. But the leading thinkers and practitioners from somewhat varied fields have converged on the same formula. Focus not on the frequency of correctness, but on the magnitude of correctness. You know how sometimes people think they need to have the latest and greatest book? You know, whatever is on the top of the pop charts, so to speak. Amazon investing, business, entrepreneurism, VC. Got to have the latest and greatest because there can't possibly be something said in 2002 that's useful today in 2015. My gosh, that doesn't make any sense. I'm a millennial. The only thing that matters is right now. Look, I'm not trying to make fun of only millennials. There's a lot of people that think that there can't possibly be something from 13 years ago that's useful in business today. But no, what Michael wrote in that paper was absolutely 100% freaking timeless. Let me fast forward to prove my timeless assertion. Well, this might not prove it for some people, but it connects the dots. Chris Dixon, internet entrepreneur and investor, general partner at Andreessen and Horowitz. That'd be Mark Andreessen's firm. For those of you that don't recall, Mark was right there responsible at the Mosaic browser level and then Netscape. In August of 1995, I don't care what anyone says, August of 1995 was D-Day. You can always go find some other particular point in time in history to say that's where things really started. But I really believe that August of 1995 was the the launch, so to speak. It was the launch of tech in the modern sense, and it was the launch of financing tech, because that was a big damn valuation when Netscape went public. It was a huge deal. Chris, on his own, as I just said, successful VC, entrepreneur, investor. He's got a pretty cool blog that I've just become aware of. So don't hit me if I should have already known about this. But he had a great blog entry that ties right into Michael Mauboussin. June 7th, 2015, The Babe Ruth Effect in Venture Capital by Chris Dixon. He quotes from Michael's paper back in 2002. And he says, quote, building a portfolio that can deliver superior performance requires that you evaluate each investment using expected value analysis. What is striking is that the leading thinkers across varied fields, including horse betting, casino gambling, and investing, all emphasize the same point. We call it the Babe Ruth effect. Even though Ruth struck out a lot, he was one of baseball's greatest hitters. See? Here's this guy today who's had tremendous success in the tech field, and he has absolutely no problem pointing to this great piece of writing from 2002. And by no means is Michael Mauboussin retired, so I would follow him on Twitter if you're not already. Michael is right there continuing to put great stuff out. He's just had a long career, so there's a lot of info. But Chris Dixon goes on to make the point that the Babe Ruth effect occurs in many categories of investing, but it's especially pronounced in VC, in venture capital. He goes on to quote Peter Thiel, making the same point. Chris correctly points out as well, people are constantly trying to avoid losses. And if so many people are trying to avoid losses, if you're willing to accept small losses, you're on the path to an edge. One of the great things in the trend following world is you have so much data, so much performance data where you can look at all of these traders over the decades to see that the bulk of their profits comes from the amplified moves. Now, Chris, I thought this was awesome. I'd love to dig into this even more, but he found a data set from another VC, another investor. And to quote Chris from his blog, as expected, the returns are highly concentrated. About 6% of investments, representing 4.5% of dollars invested, generated 60% of the total returns. It's a small amount of money, relatively speaking, generating the bulk of returns. Now you might say, why not eliminate all the other investments? If 5% is producing the bulk, get rid of the 95% losers. But the game doesn't work that way because you can't predict who's going to be the winner. That's the trick here. Chris goes on to say, great funds not only have more home runs, they have home runs of greater magnitude. He adds further, the home runs for good funds are around 20 times, but the home runs for great funds are almost 70 times. As Bill Gurley states, venture capital is not even a home run business. It's a grand slam business. And for those foreign investors out there that don't know a grand slam, that's when all men are on the bases. You hit a home run, it's 4 runs scored. It's the best that you can do when you hit a home run. It's what you shoot for in baseball. Chris concludes, quite rightly, you can't have the grand slams, though, without a lot of strikeouts. Right back to Babe Ruth, right back to Michael Mauboussin's point. And of course, for me, as a guy that's in the middle of the trend following world, I want to connect all these dots further. So I start digging through Chris's website. I make it to the Andreessen Horowitz website, and they have this cool podcast. I make it to an entry called Good Bubbles, Bad Bubbles, and Where Unicorns Come From with Bill Janeway. I was not familiar with Bill. Again, somebody can kick me in the ass for not being familiar with Bill. Venture capitalist, economist, a world of experience. In fact, all of these names, if you're not familiar with them, check out their Wikipedia pages. You can get familiar really fast. Michael Mauboussin, Chris Dixon, Bill Janeway, Mark Andreessen. Easy to figure out who these people are and their accomplishments and why it's important to this conversation. I want now to play a few excerpts from this podcast that I really love. First, Bill talking about spraying and praying.
What is distinctive about the web economy is the extraordinarily low friction in bringing new services out and people signing on to those new services and starting to use them. This means, on the one hand, a step function increase in the number of startups, in the number of Darwinian hopeful monsters,
Right.
most of which will fail. Most of which will fail pretty fast and without costing an enormous amount of money, so that at the front end of funding these, the spray and pray style of investing is rational and practical.
See, people just don't want to think like Bill is thinking. People want to think there's a secret and that the best investors just know. They know that the next one's going to be Facebook. They can just pick it out of a lineup. Doesn't work that way. Bill makes a second great point that I really loved about liquidity.
There is no more important word in the world of finance than liquidity. Because again, it's the flip side of positive cash flow from operations. It's your control over your situation. You change your mind, and there's a price that you pay, but the price gets you back to cash on your own.
I'm getting closer to connecting the dots to trend following and adding more of my trend following world to where this whole conversation, this whole discussion that I'm pushing forward today, the direction that I want to go. But that liquidity point is huge. Because in venture capital, these early phase companies, you don't necessarily have the ability to get your cash out. Now, if the Babe Ruth effect can be seen in venture capital, the Babe Ruth effect is certainly in trend following trading. And that is what is so damn sweet about trend following trading, is liquidity. The ability that when you ultimately want to have your cash back, if you're trading liquid instruments on an exchange, and of course there's no guarantee and the world could go to hell in a handbasket tomorrow, but overall, regulated exchanges, highly liquid instruments, you have a chance to get your cash out when you want it. That's huge. This last clip that I'm going to play is super spot on. If you really want to wrap your arms around the idea of expected value across fields, a multidisciplinary thinking, survivorship, critical.
Really think about the biggest outlier hits and successes of the past 10 years. They're actually first-time entrepreneurs with no track record.
That's correct.
They're in categories that we don't know even how to think about SaaS. When Mark Benioff came up with the concept of Salesforce, people were just like, what the hell is that?
So we really have to be careful about survivor's bias. And as I say, I think if what you want to do is be investing in the next Facebook, then you got to be kissing an awful lot of frogs and hope that none of them are going to leave you with warts, because most of them are going to die.
Very clear thinking there. I mean, if you're a venture capitalist and you made 20 investments, just because Airbnb was a success, does that mean that you were smarter? Or does that mean that the CEO of Airbnb was smarter? Or was the CEO of Airbnb a quote lucky survivor, even though he might be a very brilliant man with a great idea? And then from the VC perspective, your success on Airbnb was just part of the process, that you're making good bets and you expect to have some big winners and many small losses. Exactly what Bill Janeway was outlining. Now, what's different about trend following is that in the venture capital world, which probably gets a lot more attention than the trend following world, we can start to have these conversations about the winners, Facebook, Google, etc. People aren't talking about InfoSeek and Lycos and AltaVista. That's all stopped. Google was the winner. So from that perspective, survivorship bias is an interesting conversation because you can't necessarily attribute all of the success of those individual companies to the people running those companies. Now, if I look at trend following, which is not investing in companies, but investing in liquid markets, so what if your winning trades are the survivors? And let me show where I want to go with that. Look at 2014. No one was expecting crude oil to be this fabulous short. Approximately in the middle of the year, trend following traders went short crude oil. They had no knowledge that that market was going to collapse like it did, over 50%. Zero knowledge. So in that sense, for the trend following portfolio, crude oil becomes a survivor. Just like if you're a VC, you make 20 investments and one of them turns out to be Airbnb or Google or whatnot, those are survivors. But in the case of the trend following trader, and I would argue in the case of the VC, who cares if they're survivors? That was part of your idea. That was part of your plan. Your plan was to have a situation where you can't predict what the hell's going to happen. So you make multiple bets. You have strong risk management. You don't blow all of your money. You take your losses where you should. And hopefully, fingers crossed with a little luck on our side, that expected value that we've come to know that from all of our testing and experience will stay true to form, and we will end up with a big winner, i.e. Airbnb, i.e. short crude oil. So I don't know if the conversation about survivorship bias is terribly important when you're discussing your winners. Because from a trend following perspective, does it really make a hill of beans difference that you can't describe in hindsight why crude oil collapsed and you made a fortune? Does it really make a difference from a VC perspective if you can go back now in hindsight and say, oh yeah, I can see exactly why Airbnb became a winner? And of course, I'm not talking right now or attempting to say that any of the VCs that I've mentioned on this episode were saying that. I'm just using an illustration here. This entire way of thinking argues strongly against the use of prediction and the use of fundamentals. Now, I would be curious to see how some venture capitalists would discuss the use of fundamentals. Because quite clearly on some of those audio excerpts that I play, they say, we don't know what the next winner is going to be. Very honest. So if you don't know what the next winner is going to be, in whatever probabilistic endeavor that you are choosing to take, then don't worry about describing the winners in hindsight. Just be happy you got the big trend. You sure as hell didn't know it was coming, but it arrived. It paid the bills. It covered the losers. And the process keeps marching on. That's life. Best that I can tell in 15 years of talking to a lot of people and seeing behind the scenes, the best damn investors on the planet, this is how they think, this is how they act. And I'm the first one to admit, it's not a sexy conversation to throw on one of the finance channels. It just isn't. People kind of zone out, tune out. But I do think people pay a lot more attention to venture capital, to Silicon Valley. And so I see the bridge between these worlds. I see the bridge between venture capital and trend following. It's the same damn thing. And that's just interesting to note. I see a time when those awake will understand how to make money in up, down, and surprise markets. Whether new trader or experienced, college student or financial advisor, protecting against a crash or just trying to make a lot of money, trend following offers everyone an answer in uncertain times. To get started immediately, send me an email michael@covel.com. I will send you the right trend following steps to take along with my free video. But if you want to buy and hold, trust the government and trust Wall Street, this is absolutely not for you.